Hello students, in our earlier class we discussed the basic concepts of income tax and we ended our discussion with the topic rounding of the total income as well as income tax. Rounding of the total income, the relevant section is 288A, and rounding of the income tax, the relevant section is 288B. Here, paisa element is to be ignored, and if the last digit of the income is 5 or more than 5, then it is to be rounded off to the next multiple of rupees 10. And the same rule is applicable in case of income tax liability. For example, if the total amount of income 3,27,545, then we have to take the income 50. So 45 will be converted into 50, that is 50. If it is 344, then the income will be 340. And the same rule is applicable in case of income tax liability. Today we will start our discussion with a very important concept, uh, that is the concept of deduction, concept of exemption, and concept of relief or rebate. Exemption, that is, there are certain incomes which are not taxable in the income tax, and the relevant section is 10. Under these sections, certain incomes are given which are not taken into consideration for the purpose of computing of total income. These incomes are out of the purview of the income tax, and for the tax purpose the total income is computed without taking these incomes into consideration. And deduction, that is, there are certain deductions in Income Tax Act, and the deductions have been discussed under section 80C to 80U, that is chapter 6A. If the assessee fulfills certain conditions, then these deductions are available to him. The deductions under section 80C, for example, we can say insurance premium paid, which is obviously within the limit of 10% of the sum insured, investment in the public provident fund, deposit in the general provident fund, principal amount of the house building loan repayment. So there are so many examples. Medical insurance premium paid, um, under section 80G donations made, under section 80G deduction in respect of rent paid, under section 80U, that is physically handicapped. So there are so many deductions under section 80C to 80U. If a particular assessee satisfies certain conditions, then deductions are available. So deductions reduces the taxable income. Deductions reduces the taxable income. On the other hand, there are some deductions in the respective heads. At the time of computing income from house property, we will get deductions under section 24A and 24B in respect of interest on borrowed capital, that is interest on borrowed capital under section 24B, and 30% of the net annual value under section 24A. In case of salary, there is a standard deduction of rupees 50,000. So these are entertainment allowance deductions for professional tax paid. So these deductions are made. So deductions generally reduces the amount of the total income. On the other hand, rebate reduces the amount of tax liability. Rebate reduces the amount of tax liability. Actually, uh, income tax liability of the assessee is computed on the total income after allowing various exemptions and deductions under several sections of the Act. Reliefs and rebates are reduced from the amount of tax liability or so computed on fulfillment of the conditions as prescribed in the section 86, 87A and 89, etc. In a nutshell, we can say that exemptions means these are not taken within the calculation of the income or income tax, we out of the purview of the income tax. Deductions are those which reduces the total income of the assessee, and rebate is that item which reduces the amount of tax liability. So this is the main difference between exemption, uh, deduction and rebate. This is very important question for BCom 4th semester. You will study at home from any standard book. Next we will discuss the three stages of imposition of tax. Actually, in income tax, there are three stages of imposition of any income tax. What are those three stages? The first stage of imposition of income tax is that declaration of the liability. In this case, the assessee himself will compute his total income and uh, compute his tax liability and pays to the government on its own. And second stage is assessment of the income. In this case, income tax department calculates the total income of the person or the assessee and computes the tax liability and, and decides his tax liability. Third stage is very important, post assessment procedure. In this stage, uh, a comparison is made. Suppose the income tax department has computed the total tax of the assessee, which is more than the tax paid by the assessee. So in this case, the income tax department will uh, provide a notice to the assessee to pay the extra amount. On the reverse case, that is the assessee has paid the more amount of tax that is computed by the income tax department. So in this case, income tax department will make the refund along with the interest of the specific time period of the returning to the assessee. So these are the three important stages of imposition of the tax. The first one is declaration of the liability. Second one is assessment of procedure, assessment of income, and third one is post assessment procedure. Second, another important concept is what are the basic principles while charging the income tax. That is, we have to follow certain basic principles at the time of charging the income tax. Number one, income of the previous year is to be charged to tax in the assessment year, immediately following assessment year. number one. Number two, rate of tax is applicable as specified by the Annual Finance Act. Rate of tax is applicable as specified by the Annual Finance Act of that year. And number three, tax needs to be deducted at source wherever applicable, and advance tax is payable as per the Income Tax Act. So these are the three main principles of charging income tax. Number one, income of the previous year will be charged to tax in the following assessment year. Rate of tax is applicable as specified by the Annual Finance Act of that year. And number three, tax need to be deducted at source wherever applicable, and advance tax is to be payable as per the provisions of the Act. So these are the main three principles of Income Tax Act. Income tax imposition of income tax. Again, today we will say that is there are three types of the assessee on the basis of the age, that is normal citizen, individual, senior citizen and super senior citizen. In case of super senior citizen, that is the age, super senior citizen means an individual who is resident in India and is of at least 80 years of age at any time during the previous year. That can be male or female. So male or female, up to 5 lakh nil, 5 lakh 1 to rupees 10 lakh at the rate of 20%, above 10 lakh at the rate of 30%. In case of senior citizen, that is he or she must be 60 years of age and less than 80 years of age during the previous year, any time during the previous year. Up to 3 lakh nil, 3 lakh to 5 lakh at the rate of 5%, 5 lakh to 10 lakh at the rate of 20%, and above 10 lakh at the rate of 30%. And normal citizen, that is less than 60 years of age, male or female, that is up to 2,50,000 nil, 2,50,000 to 5 lakh at the rate of 5%, 5 lakh 1 to 10 lakh at the rate of 20%, and above 10 lakh at the rate of 30%. So these are the applicable rates of tax. Here another important item is rebate. Rebate, that is given under section 87A if the income of the assessee doesn't exceed rupees 5 lakh. An amount of the rebate is amount of the tax computed or rupees 12,500, whichever is lower. So if the income doesn't exceed rupees 5 lakh, then a rebate is given to the assessee, and the amount of the rebate is rupees amount of tax computed on the specified income and rupees 12,500, whichever is lower. Whichever is lower. So this is this is all for today. Have a nice day. We will discuss again in our next class the concepts of house property.